Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So as usual, we'll do a quick recap of what happened in the market. Then we'll go into a recap of some of the moves that were made in the public portfolio this week. And we'll also do a recap of all the positions in the portfolio. I'll give you a quick update on the AMC challenge, and it will talk about a couple important things to watch out for in the near future when it comes to the market. So as usual, if this video provides any value, please like this video, subscribe, and hit the notification bell so you get notified every time I post a new video. And let's get right into it. So to recap what happened in the market this week, starting this week off early Monday, we saw a sharp decline in the market. But the market flattened out later on in the day on Monday. We saw a pretty substantial run early Tuesday until we lost most of those games during the afternoon hours of the session. And that fall continued into Wednesday as well. But around mid-morning on Wednesday, that movement started to flatten out, and that flatness continued all the way into the close of the market. And then on Thursday, we saw another sharp downturn in the market, but that immediately rebounded in the early hours of the session, then eventually flattened out heading into the close for the day. Then early Friday, we saw a sharp move to the upside. Then it fell a little bit during the midday hours, but ultimately flattened out into the close. And the market closed flat for the week. So in the public account, we made two moves this week. We made one buy order and one sell order. So on Tuesday, we bought a little bit more HOOD. We bought $2 of HOOD at $33.81 a share. And this is thus, again, me continuing to buy the dip on this stock. And given how far the stock has fallen so far, I probably will not be buying any more of this stock until I see more movement to the downturn. This is mostly just to preserve cash. I really think that buying it under 30 is a really good opportunity in my opinion. But for me, I just don't want to run out of cash, so I'm not buying any more of this until we see a more substantial move to the downside. So this is pretty big news because I almost never sell off a position in this account. But on Thursday, I completely sold out of the lemonade position for this account. So I sold about $12.51 worth of lemonade stock at $53.19. And my next video will go more in depth on why I made this move. So if you aren't subscribed, make sure you subscribe. But not only that, but you also hit the notification bell so you get notified when that video comes out. But to sum things up, I saw a couple of things in the earnings report that changed my long-term conviction on this company. And in my opinion, anytime you have something like that come up in any stock, you should always sell out that position, even if it is at a slight loss. Mostly because if you don't believe in the company, you shouldn't be investing in it. And that applies whether you own shares or you don't. So for me, I thought that this would be a really good time to sell. Let's do a quick recap on how the account's doing right now. So currently the account sits at we're up $11.77 since we started this account, which equivalates out to be about 10.7%. This balance is made up of about $91 of stocks, and then another $31 of cash. Like I said before, I am keeping some cash on the sideline to be able to buy the dip on some of these stocks I like to buy. So that's why we do have a cash balance in this account at the moment. This is in order of biggest position to smallest position. So the biggest position in this account is Enphase. And like I've said before, Enphase absolutely just shot off like a rocket over the past couple of weeks. And we're up currently about 77% on that position. So that position is absolutely kicking butt at this point. Then the next position we have here is Robinhood. We're actually down on Robinhood. I believe we started buying it somewhere around $40 a share. And I believe right now it's somewhere at like $29, $28. So we are down again. I think Robinhood is one of those long play, like 5-year buy and hold kind of stocks. So we definitely weren't planning on trading it. It's just something we're going to buy and hodl. And maybe I'm the only one who didn't notice, but hodl is actually an acronym for hold on to dear life. I just thought it was a slang way of saying hold, but apparently that's what hodl means. So fun fact. So the next position we had here was Tesla. And Tesla, again, we bought it at a really good price. I believe our average buy-in price was $736.38. And right now, I believe it's somewhere in the neighborhood of $1,100 to $1,200. So we are up about 54% on this position. Absolutely kicking butt. We did have a little bit of pain with Elon selling, but I think that that's temporary pain. And again, that in my opinion, I think is going to do very well in the long run. So the next stock we have is Alphabet. It's up about 5%, which in a normal market looks solid, but compared to some of the other positions we have here, it actually looks pretty pitiful. But nevertheless, Google's doing well. Again, I think Google's another great long-term play. It makes up about 7% of this portfolio that we have here. The next position we have is Amazon, and Amazon is currently up 6.35%. Again, doing very well like the rest of the portfolio. You know, a lot of people see Amazon as being like old tech, and there isn't much room for them to grow. And some of the growth projections I see for this company, I really think that they still have a lot of growth left in them. Even though it is old tech, I would still watch out for this company. The next company we got here is Palantire. Right now we're down about 5% on Palantire. It's not a very big portion of this portfolio. And Palantire is a stock that actually currently right now I'm kind of struggling with. I think, again, this will be another video where I'll go more in depth of why I'm struggling with them. But I feel like they might not be as good of a play as everyone makes it out to be. I'll talk about it in a different video, but this is something that I'm probably not going to add to at this moment until I get a little bit more background and actually see if my concerns are valid on this company. So the next position we have here is Disney. Disney's down 5% as well. Disney's one of those stocks I just don't think you could go wrong with. They're a company that has such a strong brand. They're basically irreplaceable. Like, there's no company that can come in and fill in the shoes for Disney. In this kind of market, you know, if you have an earnings report and it has one piece of this bad news, it's like people just send the stock to the sewer. When things are down, it always makes a good buying opportunity. So there you go. The next position we have here is Redfin. Currently, we're down about 10% on Redfin. Like I said before, Redfin, again, is one of those long-term plays. I really think that with Redfin, they have the discount brokerage model, which I think may not work necessarily for every seller, for people who do and want to save that money on their real estate transaction. So, and then also another thing I like about Redfin too is the amount of real estate data they have, how they're able to gather data and they're able to use it in effective manners to come up with different kinds of estimates and whatnot. And one thing I've noticed about Redfin recently as well is that their estimates are starting to become more accurate. I'm not sure if it's necessarily because we're inside a market where prices are still rising. It seems to me that their pricing is pretty on point. You know, I'm not a real estate agent, I'm no expert, but from what I know about real estate pricing in my area, a lot of their estimates seems to be somewhat accurate. So I don't know, that's just my little opinion on that. So quick recap on the AMC challenge. Y'all know I bought 4 shares of AMC, God knows when, at $37 a share. Currently, AMC is at $41.09 a share. So we're up about 11%, or about $16.36. And again, like I said, we're going to hold this until at least the end of the year, maybe even longer. So some important things to watch out for in the markets. When it comes to budget talks in Congress, right now, currently, those budget talks are being overshadowed by the social infrastructure bill. In my opinion, I don't really think the social infrastructure bill has that much of an effect on the markets anymore. I think the markets at this point think that it's pretty much a done deal. There may be some adjustments on spending, but in my opinion, it's not something that I'm going to lose sleep over. So I'm just going to gloss over that for now. But a government shutdown would definitely hurt the market. So the continuing resolution that was put in place in October is going to run out in about 2 weeks. And there's some talk in Congress of making another continuing resolution until the February-March timeframe. And for those of you who don't know what a continuing resolution is, basically it's just budget to fund the government the same way it was funded last fiscal year into the next fiscal year for a certain amount of time. So then that extends the time frame that Congress has to pass another budget for a current fiscal year. But there are also some Congress people who want a shorter time frame for this continuing resolution. So this is something that I would hope we would see more of mainstream media talking about, especially given that the deadline is so close and that Congress is planning on taking off the week of Thanksgiving. So that pretty much only leaves them with 1 week to figure this whole thing out. But from what I've seen, it seems like most of the major details about the budget are pretty much hammered true. And they just need to really go through some of the details and fine tune that before they finally get consensus on that. Another thing we gotta watch out for when it comes to good old JOV is the debt ceiling. Again, this is something else that's kind of being overshadowed by the infrastructure bill. But Secretary of the Treasury Janet Yellen said that the government will most likely run out of their ability to borrow more money by December 15th if nothing is done about the debt ceiling. And if we do end up hitting this debt ceiling, it could be very catastrophic to the markets. So from what I've seen, it seems like the leaders of both parties in the Senate are having meetings to discuss this concern and to come up with some sort of solution. So that's good to hear, but it is very important that we do see something get passed very soon, especially when it comes to the debt ceiling, even if Congress still can't figure out the budget. So since we're talking about the government, let's also talk about the Fed chair position. I know the Fed and the government are technically two separate entities, but it's weird. Let's not go into that. Like I've said before, the Biden administration did interview Laurel Brainerd for the Fed chair position. Biden did come out this past week and said he'll make his decision fairly quickly. I believe that Jerome Powell's tenure is supposed to be over sometime in February, so there is a little bit of time to make this decision. But from the looks of things, it seems like Brainerd's track record seems to be in line with Jerome Powell's. But if there was a switch between Jerome and Brainerd, I think that there will be some short-term pain in the market, which creates a really great buying opportunities for investors. But in the long term, I really don't think that it's going to cause any massive effects to the market. But if we do get someone who has the exact opposite opinions of Jerome Powell, then we may see some serious pain in the market long term. The quick note I wanted to make about interest rates is that as we start to see the Fed tapering their purchases of bonds and mortgage-backed securities, there could be some danger to very high valuation and high PE stocks out there. This is because as the Fed starts to taper, what tends to happen is that usually causes bond yields to rise. And when bond yields rise, usually interest rates follow suit as well. It's not only the Fed's benchmark rates that causes interest rates to rise. It's also the market ability to eat or to buy bonds that affect interest rates as well. So companies with really high valuations, I wouldn't say companies like Tesla, but we could have a whole different video talking about Tesla's valuation because that is a very intense subject. But I would say companies like Snowflake, for example, that have some ridiculously high future PEs, those companies will really feel some pain if there was to be a market pullback. So if you are investing in companies like this, these very high PE software companies, watch out for trends in interest rates. And I think one of the easiest ways to do this is by looking at the 10-year treasury yield. If you see treasury yields start to move up, that usually means interest rates will move up as well, meaning that the debt that these companies take out will become more expensive to service, which will ultimately hurt these companies' bottom lines. So that's all I got for you guys this week. If this video provided you any value, consider hitting the like and subscribe button and the notification bell so you get notified when I post new videos. Let me know in the comment section what you guys think about the market right now. I would love to hear from you guys. Also, follow me on all my socials. I try to post there as often as possible. And thank you so much for watching. I'll see you in the next video.